Hi everybody, welcome to Chapter 5. I have some problems that I would like to work together in this chapter. This happens to be one of my favorite chapters in the book because most of the stuff in this chapter really relates to everybody, because a lot of us are going to deal with having things like retirement accounts and health savings accounts, things like that. So this is all stuff that's really important to all of us because it's all deductions for and from adjusted gross income, which again applies to all of us. You know, some of us may never have a business. Some of us may never have to worry about qualified business income, or some of the more complex things from other chapters. So let's first look at problem number 4 in Chapter 5. So this one is on individual retirement accounts. And as you have read in your chapter, there's a few different forms of retirement accounts. So there's not just 401ks, there's also SEP IRAs, traditional IRAs, Roth IRAs. There's a lot of stuff to know. And I think that your book explains it pretty well. I'm pretty happy with this book. I feel like it, for the most part, explains things in pretty understandable terms. Okay, so let's look at this problem here. Phil and Linda are 25-year-old newlyweds. Aw, how sweet. And file a joint tax return. Linda is covered by a retirement plan at work, but Phil is not. So those pieces of information are super important in this problem, knowing who's already covered by a retirement plan at work and who isn't. So they don't say what kind of a retirement plan, but a lot of times it's a 401k plan. So Linda may already have a 401k plan at her job that she gets to contribute to, but Phil doesn't have access to anything. Okay, so first in Part A, assume that Phil's wages are $27,000 and Linda's wages were $18,500. So looking back in Section 5-3 of your textbook, you can see that number 1 in Part A, their wages are low. They're not in any sort of a phase-out range. Those phase-out ranges are shown on page 5-9. But if you go to page 5-8, there's a section there under IRA annual contributions that says that in 2018, the maximum annual contribution that may be made to either type of IRA is equal to the lesser of 100% of the taxpayer's compensation or self-employment income, or $5,500. $5,500 is definitely the smaller number, and their income is not high enough that there's going to be any sort of phase out of their ability for their deduction to be their deduction going, or their amount going into their retirement account to be fully deductible. So they both can deduct the maximum amount, which is $5,500. And then it's going to change here in Part B. So in Part B, now they've made a lot more money. So Phil's wages are $53,000. Remember, Phil is the one that doesn't have a retirement plan. And Linda's wages are $70,000. And she does have a retirement plan at work. They had no other income. Then we want to know what the maximum amount is that they can deduct. So first, looking at Phil. So if we go to Phil, we're going to want to look at this box that's in the bottom of page 5-9. This box kind of has everything that we need to know in order to complete this problem. So they're married filing jointly. One is an active participant, and Phil, who we're referring to right now, is the one that's a non-active participant. He doesn't have a retirement plan at work, and he gets to deduct the full $5,500 because their total joint income is not $189,000 to $199,000. So Phil can still deduct the full amount. So Linda, however, is going to be different. So Linda is covered by a retirement plan at work. So I'm still looking at that same box, the AGI phase-out ranges for deductible traditional IRA contributions. And now they're still married filing jointly. One is an active participant, but Linda is the one that is an active participant. So you can see that after their combined income is $121,000, Linda no longer has the ability to contribute to a traditional IRA and have it be deductible. So Linda's answer is 0. Okay, that's it for that one. Okay, now looking at problem number 6. So problem number 6, we're still dealing with individual retirement accounts. And you guys are doing a few problems on these too. I think this topic is really important because hopefully all of us are going to have retirement accounts. Okay, so what is the maximum amount a 55-year-old taxpayer and a 52-year-old spouse can put into a traditional or Roth IRA for 2018, assuming that they earn $70,000 in total and are not participants in pension plans? So a couple key pieces of information here. Number 1, their age. They're both over 50. That's important. Their combined earnings are $70,000, which is not over any sort of a limit that's established for people that are married filing jointly. And those limits are shown on page 5-9. And then also, they're not participants in pension plans. Okay, so in section 5.3, they told us that the maximum amount that can be contributed to these IRA plans is $5,500, but there's this extra catch-up contribution that can be made by those that are over 50. And both of these people are over 50. So both of them can contribute $6,500 apiece to their individual retirement account. So that's kind of nice. If any of us are 50 years of age, I know I'm not yet. It's still quite a ways away for me, but know that as you get older, you can start contributing more to these types of plans. So the total answer here would be 65 plus 6,500, and that's 13,000. Okay, the next one. I decided to talk about several retirement plan problems just because it's interesting how there's so many different situations for so many different types of taxpayers. So this one might seem kind of surprising to us. So Bob is a single 40-year-old doctor earning $190,000 a year and is not covered by a pension plan at work. So since he is not covered by a pension plan at work, there are no phase-out limits at all. So Bob could be a 40-year-old doctor earning $2.5 million a year, and there is no phase-out limit. They're not going to say, you know what, you make too much, so you don't get to have any sort of a deductible contribution. He can certainly could have still contributed, but if they were to try to limit the deductibility of contributions, then it would just affect his taxable income. But Bob has no restrictions placed on him as far as deductibility because he doesn't have any other option. His work doesn't give him a pension plan. So Bob gets to contribute the full $5,500. Okay, now this next one, number 10, this is on a SEP plan, which is a simplified employee pension, and these are plans that are for self-employed individuals. So here in 2018, Jerry is a self-employed therapist. His net earned income is $160,000 from his practice. And his SEP plan is a defined contribution plan, and it says that states that he will contribute the maximum amount allowable. So the maximum amount allowable, which is shown in section 5.4 of your book, is the lesser of 20% of his self-employment earnings, which is $160,000, or a maximum limitation of $55,000. So $160,000 times 20%, That's 32,000. 32,000 is definitely less than 55,000. So he gets to contribute $32,000. Okay, and now one last one. Problem number 13. This is on qualified retirement plans, including 401ks. So during 2018, Jill, who's 39, participated in a 401k plan, which provides for maximum employee contributions of 12%. So first of all, not all 401k plans are set up the same and equally. Some 401k plans will limit the amount of contributions that an employee can make, even more so than the legal contributions. And this is a plan that does that. So she can only contribute 12% of her salary. Her salary is $90,000. And she wants to make the maximum contributions, which is super smart. Then she can take advantage of all that compounded interest. So 90,000 times 12% is 10,800. And we know from reading in the book that the annual dollar limitation for 401k plans is 18,500. So if Jill's 401k plan had not put in this maximum employee contribution of 12%, she would have been able to contribute more. But in this case, this is what the answer is. Okay, those are all the problems I'm going to do for Chapter 5, Part 1.